The geocentric view, where the Earth is the center, to the heliocentric view, where the sun is the center of the solar system. That's what we mean by a paradigm shift, a very big deal. And even after this was discovered, it took 100 years for scientists to embrace it, and it's been good science ever since, because there's enormous resistance to change. When you study something and learn something and taught something in a certain way and worked on the math and worked on the equations and worked on the models, you're very reluctant to abandon it. You don't want to throw it overboard. So this is what we mean by a paradigm shift, a very powerful force, and something that comes along infrequently. So I want to suggest that the Federal Reserve Bank is operating with a paradigm, and it's the wrong paradigm. It should not come as a surprise that Fed policy is consistently wrong. They don't see bubbles coming. When the bubbles burst, they underestimate the severity of it. When they become aware of the severity of it, they underestimate the duration of it. When they begin to comprehend the duration, they apply the wrong policy. The Fed is consistently wrong in their policies. They have the worst forecasting record of any major economic institution I'm aware of. The Fed does a one-year forward forecast every year. So in 2009, they had a forecast for 2010. In 2010, they had a forecast for 2011. The last 5 years, the Fed has been wrong every year by orders of magnitude, not a little bit, but a lot. Actually, if you have a Fed forecast, you can almost infer that the opposite is going to happen. So that's important, because people give them, and I've spoken to Fed governors, I've spoken to FOMC members, I've spoken to leading economists at the Fed, both current and former, the academics, professors, this whole milieu of finance and economic PhDs who kind of run our system. And they've got this completely wrong. Don't think for a minute they know what they're doing. So people who are making investment allocations, investment decisions, in reliance on what the Fed is saying, it's important to understand two things. Number one, they're making it up as they go along. They really don't know what they're doing. And two, they're usually wrong, even if they're trying to do it in good faith, because they've got the wrong paradigm. So you will be very confused, and you'll make a lot of bad decisions if you kind of listen to the Fed. I want to talk a little bit about what I call Fitzgeraldonomics, named after one of my favorite authors, F. Scott Fitzgerald. And Scott, in 1936, said, "The test of a first-rate intelligence is the ability to hold two opposed ideas in mind at the same time and still retain the ability to function." And I want to suggest that you need to do that to understand economic systems today. That what are those two opposed ideas? It's basically inflation and deflation. We have inflation and deflation going on at the same time. The deflation is natural. It comes from the fact that the world's in a depression. We're in a global depression. If you wonder why things feel a little funny, or why we haven't had a robust recovery, or why things aren't behaving the way they have in past cyclical upturns, the answer is we're not in a cyclical upturn, we're in a depression. So deflation is the natural consequence of that. People sell assets, get cash, pay down debt, reduce their balance sheet, the asset sales lower prices, it puts the next guy in distress, he sells assets, the whole thing feeds on itself. This is what Irving Fisher called the debt deflation theory of Great Depressions. But we also have inflation caused by Fed policy, the money printing. The Fed has printed almost $4 trillion in the past 5 years. So these two things are offsetting each other. If you actually look at price indices, they're fairly stable, right around 1%. Neither the inflation nor the deflation are showing up in a big way. What you have is tug of war between the two, but it's very unstable. It's not price stability, it's prices that appear well behaved but are actually unstable. It's exactly like standing on a fault line where you have massive tectonic plates underneath. You know a massive earthquake is coming. It might be very calm on the day you're standing there, but the forces are building up, and it's just a matter of time before it snaps and causes a catastrophic result. But that's sort of the world we're living in today. I want to kind of introduce what I call the blue team. This is quantitative easing. This is what the Fed is doing, and here you see the U.S. money supply. Go back to the slide for a second. I show this identity MV equals PQ. It's very simple. M is money supply, V is velocity, so how quickly is the money turning over, how fast are people spending it. PQ together is nominal GDP, the gross value of all the goods and services in an economy. It has two parts. Q is the real part, and P is a price index. So that's inflation or deflation. Now, when Milton Friedman looked at this, he said that a mature economy like the United States can only grow about 3.5% a year. It can't grow faster than that for a long period of time. Temporarily it can, but not for a long period of time. It's just the sum of population growth and productivity growth, and you add them together, and it comes out to about 3.5%. And so this can only be 3.5%, the real growth. And he said, we want P to be 1. Any number times 1 is itself. So 1 in this equation means no inflation, no deflation. Real GDP equals nominal GDP. There's no impact from inflation and deflation. Friedman assumed that V was constant. And so he said monetary policy is really easy. If Q can only be 3.5, and we want P to be 1, and V is constant, all we have to do is increase M, the money supply, about 3.5% a year, and we'll get maximum real growth with no inflation, which is central bank nirvana. And Friedman used to joke, we don't need a Federal Open Market Committee, we just need a computer to crank out kind of 3.5% monetary growth every year. So how has Friedman's idea worked in the real world? Well, here's the money supply. You'll see from 1975 to 2008, it grew exactly the way Friedman would have recommended. Nice, steady, slow growth. And by the way, through most of that period, beginning with 1980, we had very few recessions and very low inflation. So it was kind of working the way Friedman envisioned. But all of a sudden, here's QE1. Fed takes its balance sheet up to about 1.7 trillion. And then it goes sideways for a while. Here's QE2, quantitative easing. This is money printing by the Fed. Now they take their balance sheet up to almost 2.8 trillion. Then they stopped it in June 2011. In September 2012, they started QE3. Here's QE3. I try to update these charts, but the Fed's actually printing money faster than I can update the charts. So the actual number is up here. If I came back next year, it would be up here. So just kind of project that up and you'll see what's going on. So, so wait a second. So Friedman said that you should grow money about 3.5% a year. Everything else is inflation. So if this is going up 400%, why isn't inflation 397% at least? The answer is that Friedman was wrong about velocity. Velocity is actually collapsing. This is the turnover of money. Basically, you can print all the money you want, but if people don't borrow it and don't spend it, your velocity collapses and you're not going to get the growth. So you can understand monetary policy as a desperate race between increasing money supply and collapsing velocity. So this is the tension in Federal Reserve policy today. As a result of this, because we're in a depression, because we have the embedded deflation, which I described earlier, the Fed's trying to offset that with printing money. This will not work. The reason it won't work is because when you're in a depression, liquidity solutions don't work. You need structural solutions. What do I mean by structural solutions? Structural solutions are things like fiscal policy, labor mobility, environmental regulation, in the US at least, our healthcare costs, things like the Keystone Pipeline, minimum wage laws, there's education, a whole bunch of things that are structural in nature. None of those are being addressed. The Fed is trying to solve a structural problem with a liquidity solution. It's not working, it won't work, this will continue. So Janet Yellen is grossly misguided because, as I explained earlier, she's using the wrong model. She's using equilibrium models in a world that is not an equilibrium system. The world of capital markets is a complex system. I just wanted to jump ahead because we need to wrap up. So I'll skip the science part of the lecture. I want to just kind of illustrate. This is a very simple, what's called a hypersynchronous icing model as to how financial collapses occur in complex systems. And I'll just go through it very briefly. I'm assuming a couple assumptions, 310 million people. I'm assuming that every one of them has a T factor. T factor is your critical threshold. And just to explain that, we have about 200 people in the room. What would happen if 3 of you got up right now and just ran out the door really fast? What would the rest of you do? I dare say that you would do nothing. You would think that was odd or rude, or say maybe they got a text message, but they're leaving, I'm going to stay. But what if 100 of you got up and ran out of the room? What would the rest of you do? I dare say you'd be right behind them. In other words, you wouldn't know what was going on, but you'd say, gee, maybe the place is on fire, I don't get it, they're leaving, I'm right behind them. So in that example, your T factor, your critical threshold, is greater than 3, less than 100. So that's just a way to think about it numerically. We all have a different one. Ours change. Some days we're a little bolder, some days we're a little more nervous, but those are the critical thresholds. And so I want to hypothesize 100 people quit the dollar. When I say quit the dollar, I mean that they lose confidence in the dollar as a store of value. They no longer want dollars. If they get paid in dollars, they're going to buy gold, buy hard assets, buy art.